Hi, it's Roman from PensionCraft. Inflation is coming. We've just had the quarterly inflation report from the Bank of England. They say it's going to peak at 2.7% next year. So in a high inflation environment, what can an investor buy that will perform well? Let's delve together into history to find out. Buried at the back of the report are the highly reliable forecasts from the Bank of England. The fan chart represents the uncertainty in the forecast, and boy, is this uncertain. In fact, you could probably drive a Brexit bus through those massive confidence intervals. But you can see that inflation is set to peak at 2.7% in 2017. Now we're going to use a data set produced by Robert Shiller, the Nobel laureate economist, where he took the S&P index, which is the US equity index, and extended it back to 1871. The top bar is the price of the S&P 500, adjusted for inflation. Remember, over long periods of time, inflation becomes an incredibly important force, which erodes the value of your money. The middle bar is the total earnings for all of the stocks in the S&P 500, which captures a large fraction of the US stock market. And you can see the two track each other quite closely. As earnings go up, so does the price of the index. Well, of course, that's why you buy stocks. You buy a slice of the company in return for a slice of the earnings. And that's why we can use the ratio of the two as a valuation measure. We take the price of the stock, we divide it by the earnings to see how many dollars you're willing to pay for each dollar of earnings. And that's what you see in the bottom bar. When that price to earnings ratio is high, stocks are very expensive. When it's low, stocks are cheap. One of the things that Shiller's famous for is his cyclically adjusted price to earnings ratio. So instead of using just the most recent earnings, he smooths out the earnings over a period of 10 years. And that's how he comes up with his CAPE, his cyclically adjusted price earnings ratio. And you can see just before the dot-com bubble burst, it was at an all-time high, above 40. At the moment, it's rising very quickly, and US stock is starting to look a little bit pricey based on this measure. Shiller's data also has inflation going back for 130 years. So what I've done here is I've plotted the valuation of stocks using his CAPE measure versus the value of inflation. So on the right, we have inflation, and on the left, we have deflation. And what you can see looks a little bit like a sorting hat from Harry Potter. During periods of very high inflation, you can see that equity derates. People are willing to pay less for the same earnings when inflation is very high. The same is true of deflation. When the cost of living is falling, equity also derates. People are willing to pay less for the same amount of earnings. The sweet spot for inflation is around 2 to 3%. So as long as inflation doesn't get too high, and by that we mean above about 4 or 5%, equity shouldn't be too heavily impacted. And the reason for that is that if the input costs of a company go up, they'll pass that on to their customers. So inflation is like chocolate. You don't want too much or too little. In the press, it's often said that gold is a good thing to buy during periods of high inflation. Well, that certainly doesn't seem to be the case historically. Okay, sometimes the price of gold goes up when inflation is high, but sometimes it doesn't. And that means gold is a very unreliable hedge against inflation. But there is one instrument which is like a torpedo for inflation. It's designed exactly so that it protects you against inflation. This is called an inflation-linked bond. Now for normal bonds, inflation is their mortal enemy because you receive a fixed income and any inflation gobbles away that income. I've shown you one of those bonds on the left during its entire lifetime. This was a treasury bond issued by the UK government. This particular bond was issued in 2011 and it was issued at a price of £100. You can see that the price flops around a bit, it goes up to 105, but then just before the government repaid the debt in 2017, the price fell back to 100. Because that's the way a standard bond works. You lend 100, you receive some interest, and then your £100 principal is repaid. On the right, you can see a very different animal. This is an index-linked bond that was issued in 1996. It also started out life as a loan of £100 to the government, but over time the principal of the bond increased in line with inflation. So currently it's worth £370. So in other words, this provides a guarantee that your investment will rise in line with inflation. And now the legal bit. This is not a recommendation, and these figures refer to the past, and that may not be a reliable indicator of future results. And so to summarise, inflation is the mortal enemy of bonds because it eats away at their fixed income. Historically, we've seen that gold is a very poor hedge against inflation. Shares are okay as long as inflation doesn't move too far away from its sweet spot of around 2 to 3%. But the asset that really works is an inflation-linked bond, because by construction, your coupon income and your principal repayment will grow in line with inflation.